Hello, everyone. Happy Monday. It is April 3rd, 2023. Today on the Final Bar, we'll recap today's movement, sort of a mixed bag of sorts. The Dow moving higher, the NASDAQ moving lower, the S&P right there in the middle. The big story today, big bounce higher in energy. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a kind of snowy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit, as we use on StockCharts.com, is really designed to help you understand these markets by focusing on the message the markets provide back to us in the form of price and breadth and sentiment, some of these other measures of market dynamics. Again, to help us build what I call our situational awareness or our market awareness to understand what's happening. Today's sort of an interesting day. If you look at the big gainers list in the S&P, it's a lot of energy stocks, right? Names like Marathon Oil, ConocoPhillips, Hess, Halliburton, all up 7, 8, 9, almost 10% as oil prices gap higher. But outside of that, what are the markets telling you? Sort of mixed. The weather around our office in Redmond, it fluctuates from clear to rainy to snowy out at my house up near the mountains. So literally, depending where you're at, the weather conditions are very different. I feel like the market today is giving us the Seattle weather sort of vibe, where it's very different depending on what part of the market you're looking at. We're going to key in on some of those particular signals from different areas of the charting world here on our market recap. So let's get right to it today. So as we're looking at the markets, we see the S&P netting out to about 1/3% higher, the Dow moving a full percent higher, and the NASDAQ composite actually down about 1/4%. Mid caps and small caps were both flat for the day. That's there, the S&P 400 and S&P 600. And we can see the volatility is continuing to decline overall, right? So there have been, range in volatility over the last year or so. It's fluctuated from about 18 to 20 on the lower end up into the 30 plus range on the upper end. We're certainly on the lower end of that. And, the market moving higher on lower volatility is certainly an ideal condition for a bull, right? Is to see that sort of steady move higher. And what's interesting is if you look at the charts of Apple or Meta or Nvidia, that's kind of what it looks like, right? It's sort of a steady trend higher on low volatility. But that's not all the charts that we're looking at. Again, we're look at some of the others, some of those names and some of the others that disagree with that trend here through the course of our market recap. Interest rates overall moving lower. We had some economic data that came out this morning. I think it was factory orders. I forget which one it was. I'm so sorry, I don't remember. But we had one of the economic readings. I think it was factories this morning. And essentially, basically, bonds moved higher as a result of that. The idea that inflation a little more in check. However, if you look at what's happening, or there's a bit of an economic slowdown, but if you look at oil prices gapping higher, it's sort of the total opposite signal. So mixed signals today from economic data and commodities. Bonds moving higher, so interest rates moving lower. You can see that TLT was up about 0.5%, the dollar down about 0.5%. And again, when we look back at the last 3 months, look at year-to-date 2023, dollar pretty much flat for the year. Crude oil with the gap higher today, about flat for the year as well. And that's at the same time, other parts of the commodity space, particularly gold, having a pretty decent year, up about 8%, 9% for the year at the same time. The GLD today moving up about 0.7% to just below around 184.50. Gold prices overall have remained pretty strong. Interesting to see some commodities related names starting to pop up in our top ranked names according to the Scooter rankings. That's the StockCharts technical ranking. AU, if I remember right, is a gold name. We'll see if others continue to pop up if you see further movements in gold prices. The real story again in the commodity space is a jump higher in oil prices. The OPEC announcing change in supply. This is causing prices to gap higher. Crude oil prices moving higher. Energy stocks, generally speaking, moving higher. But, again, you take that gap up in energy off the table, and it's sort of a flat to down day, right? Sort of a mixed bag of the rest of the sectors. Finally, cryptocurrencies, mixed bag as well. You can see Bitcoin down about 0.5%, Ether prices up about 1% to just above 1,800. So, Bitcoin again over the weekend still sort of around that 28,000 level. Overall moving a little bit higher, but not really getting up to 30,000, which is that big round number we've been sort of keying in on for quite some time. Let's look at some of these charts in a little more detail, and then we'll get back to the sectors and some individual stocks on the move. Here's a daily chart of the S&P 500. And if there's anything I would take away from today's session is, we talked on Friday about that move above 4,100. Kind of interesting, right? The blue shaded area is about 4,050 to 4,100. The question is, can we trade above resistance? Can we push above? Have enough positive momentum to not just trade up to the previous resistance level, but actually trade through it? Today, kind of a decent follow-through day. You got to feel good, I would say, overall about the S&P moving higher to 4125. We'll call it. The last time we got above 4,100 was back here in February. We had about 2 higher closes, and that was it. We got up to just below 4,200, and that was the end of that rally. So we're now sort of in this new resistance range. I would say the fact that we're above 4,100 is pretty bullish. We've been talking on this show about that 3,800 to 4,100 level. That's sort of the range of this market over the last 6 months. We'll call it 5 months, really. And getting above 4,100, bullish. Getting below 3,800, I would argue bearish. And in the middle is neutral, right? And if you look, the S&P is the same place it was 1 month ago, 6 weeks ago, 3 months ago, 10 months ago, 8 months ago, all around that same level, around 4,100. So can we get above there and stay there? That's the real question. That's what we've been unable to do. And I think if we would do that, that's what would start to make this market look less like a sideways consolidation phase and more like a bottoming phase that is actually showing upside follow through, right? Actually showing that there's further upside. Now, stocks like NVIDIA and Apple and others have been demonstrating strength, have made it well above their February and January highs. The broader markets have not, because a lot of other stocks are still sort of stagnating. So improving breadth conditions would allow these the major benchmarks to move higher. For today, for what it's worth, and the bounce in energy certainly is a factor here, but overall the S&P continued to move higher. So I think the proof is in the price, right? As long as price is going up, conditions are bullish. One of my, a mentor that I used to read often named Paul Montgomery, he used to say, the most bullish thing the market can do is go up. And for today, and certainly for the last couple of weeks, that has been the case, right? We've moved higher. So we have now gotten above 4,100. Let's talk about what happened today to push the markets above that resistance level. Well, the energy sector is not a huge weight in the S&P, so let's keep that as a caveat. That's why the Dow is up a full percent, because there are a couple energy stocks in the Dow, and that's what's that's causing that group of 30 stocks to move higher than the S&P and the Nasdaq. But the XLE finished today up about 4.5%. That's a decent update for a sector. While it has been one of the stronger sectors at times over the last 12 to 18 months, certainly recently, and year to date has not been, right? While other areas like technology have been thriving, things like energy and other similar sectors have been sort of stagnant, right? Sort of treading water. We'll look at a couple of those charts here in a minute. But for what it's worth, energy, the number one sector, healthcare number two, up 1.1%, materials up third, and that's up 0.6%. Couple sectors were actually down on the day. Consumer discretionary, most notably, was down about 0.9%. That was the worst performing sector today, narrowly edging out real estate for that dubious honor of being the worst performing sector today. Utilities right after that. So two fairly defensive sectors and a pretty offensive sector, consumer discretionary. So real estate and utilities down as well. So overall, is there a general risk on, risk off takeaway from today's sector movements? I don't think I would necessarily say that because there's some offense on the top and some offense on the bottom. Same to be said for defensive sectors like consumer staples or really healthcare, which are sort of the more defensive parts of that, like big pharma are kind of moving higher today. It's not a great look. And then on the downside, you have an offensive sector and defensive sectors that are moving down as well. When you look at individual names in the big movers list, striking, of course, that most of the top 10, as a matter of fact, all 10 of them, as I'm glancing down through the tickers, are all energy stocks. So things from Devon Energy up 5%, Marathon Oil up almost 10%. The other 8 are all energy stocks. So energy really the story on the upside. Things moving down, notable Tesla down 6% today. And again, there's a reason for that, right? Sort of, they gave their update on monthly deliveries. But if you look, at what happened with the chart of Tesla moving higher on Friday. And let's actually get into that chart here to continue it. On Friday, we're looking at this chart moving above 200, closing above 200 for the first time since February. And 200 was a pretty clear resistance and really above there, right? If you look 200 to 220, that's where we stalled out in February. The 200-day moving average right around that same level. So while Tesla has been strong off the lows, truly almost a double off of the lows at the beginning of this year, we're sort of hitting that resistance from February. We're retesting it. And the question is, as we moved higher on Friday, is there enough momentum to push us above resistance and above the 200-day? Today, not the case, right? Today, we're actually moving the wrong direction with Tesla down about 6%. So down a lot is certainly something to note. But I think the technical story, right, or the technical implications of today's move is that it once again just confirms the fact that we're at a very important resistance level. And until Tesla can get above the February highs and above the 200-day, which means you really need to clear 215, if not 220, then Tesla at best is testing resistance, right? Once you get above there, then we can talk about Tesla regaining some steam and moving further to the upside. But at this point, it's really trading to resistance and unable to get much further. With that as a background, let's talk a little bit about energy, right? So the chart of the XLE, the gap higher is what you're seeing here, up in about 4.5%. Now, again, some of the energy stocks up, double that plus if you look at some of the names that we mentioned earlier. But, the XLE gapping above the 50-day moving average, that's encouraging. It's actually gapping up to the March swing high, which is right around 87, which is where we're circling here from early March. Can we get through it? So, question for energy, what's encouraging is we're breaking above trendline resistance. And if you look at the XLE, if you look at COP, sort of a similar look, right? You have a trend line connecting the recent highs. We've gapped above those. That's encouraging. But the question is, can we follow through, right? Can we sort of get above? And the problem for a lot of the energy stocks is there's overhead resistance to speak of. For something like ConocoPhillips, I would say can it hold the moving averages? So we gapped above or gapped up to the 50 and 200-day moving averages. We closed above them today. That's super encouraging with the stock up over 9%. Is their staying power, right? What differentiates a one-day gap higher with more of a sustainable advance is you actually have to follow through, right? Tomorrow, you see additional buyers that are willing to pay $109, $110 a share and not just the gap up to 105 to 108. So I think the question mark for energy is, can we continue up there? Can the RSI push higher, which would put it in a area of positive momentum? If you look at any of the energy stocks that are in the top gainers today, I think you'll find similar patterns. We'll finish with this chart of Diamondback Energy, ticker FANG. Similar in some ways to the charts of the XLE, the charts of ConocoPhillips. What's a little different here is you have a really fair, really consistent resistance level around 145 to 150. We've now gapped up right to that resistance level. So while this is encouraging, again, very much encouraging that we've gapped higher, the sustainability of this advance would need to push us above resistance. And I think that's where energy still has a lot from a technical perspective to prove before you can say this is a thumbs up, completely bullish technical setup. Let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com. It is such a pleasure to have you join us every weekday after the close. We appreciate you tuning in. A couple quick announcements before we continue on with the Final Bar mailbag. First off, the mailbag is fueled from questions from people like you. If you can shoot us an email with any of the questions that come up as you were trying to use technical analysis to analyze these markets, we'd love to hear from you. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we are on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer your question on our next mailbag, which will be Friday of this week. Upcoming schedule, just so you know, today is my birthday. Happy birthday to me and also to our producer, Sky Boggs. Now, what's hilarious is my producer who runs the show and me who hosts the show somehow have the exact same birthday. I don't know how that actually worked out, but irony of ironies, it's the case. So happy birthday, Sky Boggs, as well. Upcoming guests, we've had some movement in the guests. We're getting schedules lined up, but we do know on Thursday of this week, on April 6th, we'll have Joe Rabel. Joe's the founder of Rabel Stock Research, based in the DC area. Joe's fantastic. He was a guest speaker at our ChartCon event last fall, did a really, really good job, and hosts a Q&A style show on StockCharts TV. We'll have him on sharing some of the stocks that he's watching on Thursday. And then on Friday, as a reminder, we'll do our mailbag. So make sure you get your questions in. And with that as a setup, let's continue on our show today with the Final Bar mailbag. Keep your questions coming, and let's get to question number one. Julius DeKempeter, who very happily and powerfully hosted this show as I was out over the a couple times over the last week, he showed the chart of POWI, and he said that he identified it with a scan for stocks trading below their 20-day low. Could you show us the syntax for that scan? And there are a couple ways to do that. Our scanning engine, I would remind you, is super powerful. If you're not using the scanning engine, you're missing out on one of the real benefits of the StockCharts platform. And as a reminder, as a premium member, as a paid member, as a extra member, a pro member, you really have the ability to make the scan engine sing and do some really cool things to dissect and understand the equity and ETF space. Having said that, there are a couple scans that I'll show you because there are a couple different ways to do it, to be honest with you. Two ways that I do it. The first one I'll show you is more of a weekly scan. So I actually run a scan for my market misbehavior premium members. I write a report every Wednesday where I focus on stocks making new swing highs. And I define that as stocks making new 3-month highs or 3-month lows. And so I use the scanning engine to automate that scan. Here's the language that I use. And a lot of this is just sort of bringing the universe in, like I'm looking at stocks, a market cap above 5 billion, on certain exchanges, et cetera. But this line number 3 is the one you really want to focus on. It's a simple argument, which basically says the weekly close is greater than last week's maximum close, or looking at the last 13 weeks. That's what that syntax means. Basically, last week's maximum basically means the highest of these observations, which is the last 13 closing weekly values. So this is something, because I do it every week, I don't want to miss something if it happened yesterday and today's a little different. So what I say is just look at where we're at today, the current, basically the close of the current week, which will use the current week's, last price if you run it during the week, and says, I want it higher than the last week's maximum for the previous 13 weeks. So this is, if you use this syntax and change the numbers or change the language, that's going to allow you to focus in on that. So you could do that same thing with, like this, or you could say less than last week's MIN 13 close would be a close lower than the last 13 weekly closes. Now, if you want to do it more day to day, you can actually say, tell me if something is happening on this particular day. And then you just use, instead of weekly close, you can use the daily close argument. So here, same syntax. I'm saying daily close is greater than yesterday's daily max and the maximum of these items, the last 65 daily closes. And if you're doing a new swing low, you basically just reverse that argument. Less than instead of greater than, min instead of max. And the syntax works pretty well. So that is how you do it. As a reminder, it's easy to just take, if you hit pause, just copy and paste that exact text into your scan, and it's going to work pretty well. You can also use the drop-down menus below the scan engine. And if you select anything, click on add, it'll add the language that the scan engine needs to search for that thing. And when you're done, click on check syntax. That'll make sure you didn't mess anything up. And if you're struggling with it, just ping our support desk and ask them what you're trying to do. They are very, very good with the scan engine for sure. Question number 2, can you still say that charts reflect investor sentiment in the era of YOLOing, or you only live oncing, and zero dates to trade options, or zero DTD options? I get this question a lot, and the reason why I'll tell you, yes, I can say charts reflect investor sentiment in the days of YOLO and FOMO and zero DTE and cryptocurrencies is because, and I'm not exaggerating, 23 years ago, when I started in this industry in mid-2000, I was asked, does technical analysis still work in the age of decimalization, right? Because the big change at that point was we'd gone from stocks trading on 8ths or 16ths to trading on decimals and now sub-pennies. Do charts still work in the era of hedge funds, in the era of algorithmic trading, in the era of fill in whatever market structural change here? And there are the same concerns, and I would argue that the charts still work. Now, do all of the indicators work the same? Absolutely not. And I would tell you one of the biggest changes that I've seen, certainly in my own use of technical analysis since I started in the industry, is how I think of volume. So when I started in 2000, there was a lot of discussion on, money flow, and not Mark Chaikin's version of money flow, but Laszlo Barini's version of money flow, which actually looks at tick data and looks at block trades versus non-block trades. And that had started to become less effective because tick data was, it was not like you had a single exchange with a single source of data. You all of a sudden had dark pools and different, exchanges that were reporting trades in different orders. And so the value of tick data to measure volume and institutions was less meaningful. Volume today versus volume 50 years ago on a stock, I think tells you something very different, because ETFs didn't exist and now they do. The way that ETFs rebalance, the way that institutions scale in and out of positions, all of that has changed. So I would say that, 50 years ago, you could say a stock moves on volume of a certain amount, and you could assume that there are big institutions making directional bets, and that's what the price and volume relationship means. I would argue at this point, volume probably tells you very different, and it could be, hedging trades, it could be high frequency trading, all of those things. So I think volume a little less meaningful, probably in my own experience. Having said that, I think breadth still works, and I think relative strength is still super valuable. And I would tell you, having spent a lot of time with institutions that run quantitative models, what they are trying to do is model human behavior as much as possible. So while we think, oh boy, what about all these structural changes? Are they impacting charts? I would say more than anything, it's accentuating the fact that investors are irrational and they make bad decisions. And every model I've ever seen is trying to just adapt to that and anticipate that. So I would argue, yes, charts reflect investor sentiment very, very well. I would say certain indicators certainly have become more or less valuable, and I would stick with the ones that have worked. And the ones I demonstrate on this show certainly fill that requirement, in my opinion. Next question. Financial stocks are down dramatically. What is the next major support? That's a really good question. And this question, I have had a number of questions like this in the last couple of weeks with the sell-off. We're looking at the XLF right now. And so, how to think about this. So we talked about this a little bit last week, because a lot of charts like the XLF and a lot of the banks actually had given a buy signal from something like RSI, which became very oversold and actually came out of the oversold region. You can see with an indicator like PPO, which I'll add at the bottom here. This is the similar to MACD. It's called the percent price oscillator, interpreted very similar to MACD, and it's calculated almost identically, which is a downtrend when the MACD or the PPO gets very low, and then you get a buy signal where the PPO line crosses up through the red signal line, which we saw about a week ago. That tells you that the trend had been down in a big way, and all of a sudden was starting to go higher, and was showing you that buyers were coming in and pushing the price higher. I think one of the things I've noticed is that with a lot of the financial stocks that had been so beaten down in early mid-March, given the sort of mini financial crisis, as I would be calling it, the fact remains that the XLF was getting down to previous support. A lot of individual stocks in a similar kind of pattern. Stocks became oversold, and now all of a sudden, having alleviated that oversold condition, the PPO went from confirming a downtrend to almost sudden signaling that the downtrend was over. So at the very least, this feels like a counter trend bounce to the upside. At best, this is telling you that the banking crisis is no longer an issue on these charts. It's starting to rotate higher. Now, my question, if you're looking at a bank like this, is why would I want to own a bank as opposed to charts that are in much better technical setups, right? Would I want to do an XLF or like an Axon, which is one of the top 10 stocks in our Scooter large cap rankings? Now, again, is this a little, has this been up a lot? Of course, but this is a chart in a traditional uptrend, right? Think of NVIDIA or Apple or any other charts like this. Given the choice of something like a beaten down bank with a big question mark as to how this financial crisis, if there are ripple effects, versus a chart like this that's making higher highs and higher lows, personally, I would opt for a chart like this every 10 times out of 10, if not 9.5 times out of 10. So that's the question. I think the challenge for banks are not whether or not the price maybe has bottomed out, which it may have, at least in the short term. It's the relative strength, which is clearly favoring other places than financials. Next question. You've mentioned how much of a rate hike the market is pricing in. How can you tell this from bond yield charts? So great question. I would say it's actually very difficult to measure that from bond yield charts. If you're asking that, I would normally think of something like either the 10-year yield, which is something we refer to often, or something like the 2s10 spread, which I actually show on the bottom of this chart. That's the spread between the 2-year yield and the 10-year yield. So this is the flattening and then the inverting of the yield curve when it goes below zero. This is showing just the simple level of the 10-year yield, which is currently around 343. So can you tell what the market is pricing in here? No. I would say two things. When rates go down, though, it is telling you that bond prices are going higher. And what you have to remember is part of the idea of looking at fixed income prices, particularly the treasury markets, is when bond prices move higher, it's often sort of a safe haven, right? People are getting defensive and moving into bonds and betting on that yield and that more risk-free guaranteed income that buying a bond sort of represents. So when bond prices are going higher, certainly if they would move higher as stocks are selling off, that tells you that there's more of a safe haven play and people getting a little more defensive. So I would say that is pricing in uncertainty. If people are really nervous about the economy, much more likely the bonds would start to do better as equities were struggling. And I think you could interpret that. But the short answer of how you do it is you actually need to look at the Fed funds futures market. And that is a traditional methodology. There are Fed funds futures that are actually essentially pricing in the probability of the rates being at a certain level at a certain point down the future. In the future, if you Google CME, which is the Chicago Mercantile Exchange, CME Fed Watch, they actually have a free tool on their website where you can actually see the Fed funds futures traded on their exchange. You can see what the probabilities are about Fed rate hikes or tightening cycles. And if you look toward the end of the year, you can see the market is pricing in rates actually going down again. All of that can be calculated by looking at the Fed funds futures and interpolating it. We used to have a crazy Excel spreadsheet we would use to manually calculate that. The CME actually provides a free tool on their website called the Fed Watch tool. I would check that out if you're struggling to understand what is being meant by that. Folks, that's it for our show. We need to wrap it up. I go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. New Dow theory is looking at the S&P 500 and the NASDAQ composite. This is derived from Charles Dow's, what we call Dow theory, which is looking at the Dow Industrials and the Dow Transports. He actually did the Dow Industrials and Dow Railroads as a way to measure the overall economic conditions. And when both of those indexes were breaking out, conditions were good. When one of them broke out and one of them did not, conditions were not so good. And that was called a non-confirmation, a bearish non-confirmation. This chart is one that I'll be talking with my market misbehavior premium members tomorrow when I host our monthly chart review. And what we're going to talk about is the fact that this may be a really important way to identify a non-confirmation. The NASDAQ composite is currently testing its high from early February. The S&P 500, not quite there. That's just below 4,200. If both of these break to a new swing high, that is a new Dow theory confirmed bull signal telling you conditions are fine using those two indexes. If one of them breaks out, like if the NASDAQ would break out and the S&P would not confirm it, that would be a bearish non-confirmation. It may tell you April, May will be a little less optimistic than maybe priced in at the moment. Chart number 2 is Devon Energy, DVN. I think this represents one of many energy stocks gapping higher today. Now, DVN was up about 5.3%. The XLE was up about that much, maybe a little less, but some individual stocks that we've highlighted in our market recap were up double that amount and having a pretty decent update as OPEC with their announcement today causes oil prices to gap higher. What's good about this chart is it's going up, and that's encouraging, right? Anything up 5%, I'm going to look at it and see what happens. Here's the problem. It's trading up to a descending 50-day moving average. A trend line using the 2023 and late 2022 highs is up here, and the 200-day moving average is around $59 to $60. So I think DVN still has more to prove to differentiate between a gap higher, which is what I saw today, versus more of a sustainable advance. And I think with a lot of the energy stocks, they've gapped higher, but the question is the follow through. I think that's why these are important charts to watch through the remainder of this week. Finally, having said that, speaking of stocks that have bounced higher, but not enough to sort of give a full bullish thumbs up and to the right, long and strong type of signal, Amazon and Tesla. Now, can the market rally without Amazon and Tesla participating? Of course it can, right? That certainly is possible. However, I would feel much more confident as a bull if an Amazon was above its 200-day and not below. If Tesla was going above its 200-day and not below, which means both of these stocks still have a little bit to prove. Both have failed at their 200-day. Can they regain them? That's the question for the rest of this week and beyond. Folks, that's a wrap for the show. Thanks for joining us every weekday after the close, and check all of our previous episodes out at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.